Hi, I'm Brooke Thackeray with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizons Seasonal Rotation ETF, ticker symbol HAC. Its weekly commentary is the basis for this market update. So let's jump right in and take a look at the market action last week. Here we can see the S&P 500 was up a solid 2%. The Canadian stock market matched that, also up 2% as well. We saw a couple of news announcements last week driving the market higher. The Federal Reserve, the first one was the Federal Reserve coming out and announcing the tapering of its quantitative easing program. Currently, the Federal Reserve is purchasing $120 billion worth of treasuries and mortgage-backed securities per month. The Federal Reserve came out and said that they're going to start tapering that by $15 billion per month, which, if you do the math, means that by June 2022, the Federal Reserve will finish its quantitative easing program. Now, the Federal Reserve did have a caveat in there and say that the tapering process is data dependent. In other words, they can change their minds. Now, the Federal Reserve maintained its narrative of inflation being transitory and also said that the Federal Reserve raising the Fed funds rate is still quite some time in the future. Overall, investors like what they heard and moved the stock market higher on Wednesday. On Friday, we did see the non-farm payroll come out, and we saw 531,000 jobs being created in the month of October, which is higher than the 450,000 expected. Investors like what they saw and pushed the market higher on Friday. Last week, we did see HAC reduce its industrial sector position and increase its technology sector position in the markets. If we take a look at the action last week for the S&P 500 here, this is Monday positive, Tuesday positive, Wednesday positive, Thursday positive, Friday positive. Every day last week was positive. Here's the reaction for Wednesday to the Federal Reserve's announcement, and then on Friday we saw that positive day with the non-farm payroll number coming out. If we take a look at what was happening at the sector level overall, we can see last week we did see, as a reference here, the S&P 500 up 2%. Consumer discretionary up over 5% last week. Great week for that sector. Technology up over 3% last week as well. Materials did quite well. The consumer staples, actually, surprisingly, it's been a laggard, but also did quite well last week. The U.S. energy sector was down, not down, but it underperformed the S&P 500 once again. If we take a look at what's happening on the 10-year Treasury note, we can see that on Monday we saw the 10-year Treasury note rise up here a little bit, and then Tuesday it was down, Wednesday up, Thursday down, and Friday a huge drop. We saw the yield on the 10-year Treasury note close at 1.45 for the week. So what's important about this is we saw the action on Friday, quite a big drop on the yield. At the same time, we had a positive economic number come out with the non-farm payroll number, and which moved the markets higher. This could be indicating that bond investors aren't totally sold that on the whole economic expansion here, and it's going to be persistent as well. So it's going to be interesting to see the way that this plays out next week. If we take a look at the 10-year Treasury note yield over time, this is a longer-term graph here, but going back quite a few months. Here we can see that here's the start of October. We saw the 10-year Treasury note, actually, here's the end of October right there. We saw the yield on the 10-year Treasury note go up in October on a seasonal basis. On average over long term, that is actually what's taken place. But we've seen from about 2/3 the way through October to current, we've seen the yield pull back lower. So this is going to be interesting because if we are seeing a stronger economy and more expanding faster than what people previously thought, you would expect the yield on the 10-year Treasury note would increase, and we haven't seen that take place. So where do we stand for the markets this week coming up? Well, this week we're going to look at the inflation numbers coming out, and this could impact the markets overall because investors have been talking a lot about inflation, and Powell's been pushing back on the whole narrative about inflation not being transitory. He's maintained that it's transitory. So on Tuesday, we see the PPI, the Producer Price Index, coming in. The expected on a month-over-month basis is 0.6% growth. Now, previously last month, it was reported at 0.5%. So we're looking at a higher figure as well. And the concern is that producer costs, if the producer price index is going up, that will be transferred over to the general economy and show up in the CPI later on. On Wednesday, we see the CPI numbers coming out, and it's expected that to show 5.8% growth on inflation on a year-over-year basis. Last report was 5.4%. So once again, a higher figure than expected. So I expect that we'll see a lot of sensitivity from investors around the inflation report coming out. It's going to be interesting to see how investors react to these numbers. If they come out on the high side, if they push the market higher or lower, and even if they actually are lower than expected, and how does that transfer? We did see that interesting development last week with bond investors pushing the yield lower on the 10-year Treasury note on Friday on a stronger economic report. So we're going to see a little bit of a battle between bond investors perhaps this week, and also stock investors as well. Once again, an interesting week to watch. Thank you very much for joining me today.